The information provided in this program is of a general nature and is not intended to be personalised financial advice. We encourage you to seek appropriate advice from a qualified professional to suit your individual circumstances. Reporting season kicks off today. How much red ink could we see? And an exclusive interview with big-time US innovation investor Cathie Wood of ARK Invest. Her take on Tesla and message to her followers after they've suffered significant losses. You don't want to miss this. It's Monday, February 13th, and you're watching Markets with Madison. Welcome to the start of your working week and to this new show by the NZ Herald. I'm Madison Reedy, and I'm here to bring you investment analysis and insights from the experts. From meme stocks to macroeconomics, bull market or bear, I want to help you make sense of market moves and trends. You can find this show on the NZ Herald every Monday and Friday morning and across our social media channels. All right, let's rip in. Reporting season starts this week, and investors could be in for a shock when they see company financial results. Harbour Asset Management portfolio manager Shane Solly says this season we could start to see cracks in company finances. Thank you so much for joining us today, Shane. Could this be the season that we finally start to see cracks in some company finances?
Yeah, look, hey, Maddie, there's certainly in the pre-result season, we saw a real absence of confessions. So we didn't see companies coming out and downgrading. In fact, we saw a couple of companies upgrading. There's a slightly better updates. But look, I think when we think about that, that does not mean the risk for the actual result season is good. It could be a bit of a challenge still. This December period, which we're reporting on now, it could be okay. Company management teams have been really conservative in their guidance in the last year. And so investors have come into this result season not expecting a big rip. But companies, they may not have seen the full impact of the slowdown yet. We know equity markets, they're all about expectations. So we'll be thinking about exit run rates. How have you been going in the last few weeks? And outlook statements. What are company management teams really saying about what happens in the next 6 to 12 months? So we could see a real dispersion emerge post results. And I think, we've got to think companies, they may not provide outlook statements. In the past, we've seen companies provide outlook statements. But because of this, the sharpest increase in interest rates in 30 years, companies might be really cautious about providing outlook. So the focus for investors will be on how deep, how far is this slowdown really emerging?
When you mention a slowdown, what could actually cause these so-called confessions from companies? I'm assuming higher interest rates, high inflation?
Yeah, definitely. It's just slowing down revenue at the same time that we've got costs holding up. So it's a real difficult pressure point for companies. The actual results this round could be okay because we haven't seen the full force of that increase in rates that central banks have put through to really stamp on inflation. It could actually be the next result season. We also know the New Zealand stock market, because of its composition, it's quite defensive, right? A lot more defensives, a lot more cyclical growth stocks than the broader New Zealand economy. So it's less exposed to the slowdown. And because company management teams have been so conservative into the lead up, they could actually say, yep, we're going to keep trimming. Results aren't quite as good. We've got to do something. We are seeing companies globally talk a lot about efficiency gains, having to do the hard yards of cutting employment, taking people out of their businesses, really cutting costs to get their productivity and profitability back. So we wouldn't be surprised to see a bit more of that come through in this result season as well.
How painful could this be? What scale of reduction in earnings would you expect to see in this type of economic downturn?
Yeah, look, historically, we would have seen 10 to 20% reductions in earnings, quite meaningful. What we tend to see is these cuts in forward earnings forecasts from the market. They tend to be a bit of a death of 1,000 cuts. Terrible term, but they're incremental. So I would expect over the next few reporting seasons, we'll continue to see forward earnings forecasts continue to be trimmed. However, what we see is the odd company comes out with a real clanger and they get hit hard. We've seen one or two companies already come out and say, hey, look, we're going to have to work hard to hit our numbers. We've got to put some real changes through our business.
What companies are those that you're avoiding that you think could be hit by all of this?
Yeah, we're quite worried or quite anxious about companies that are really exposed to the more cyclical parts of the economy, the ones that are really sensitive to the ups and downs in the real economy. And also there's a number of businesses that have had a bit of a free kick from COVID. They're still getting super profits. that are perhaps not sustainable when we normalize. And look, we're not normal. It'll be a while before we're normal. We've still got COVID hitting parts of the economy. Those businesses are perhaps still yet to see some of that profitability wash out of their earnings forecast. And similarly, inflation is a real bugbear for forecasting earnings. Some companies have just done really well by having inventory in the right place at the right time and being able to jam up prices. Maybe that's not as sustainable going forward.
Could any company be spared?
I think there are some businesses that are, by their definition, they are quite insensitive to activity slowing down. So, for example, the electricity generators, they still need to sell in their product, which is electricity, into economic demand. If it slows down at the margin, it may impact them, but much less so than other parts of the economy and parts of the market.
Thank you so much, Shane. Appreciate your time this morning. Stay safe and dry, please.
Yeah, you too. Thanks, Maddie.
Now, many of us know just how much growth stocks got smashed last year. Well, Cathie Wood from ARK Invest certainly knows. Last year, her flagship fund had a total return of negative 60%. But Wood, she isn't folding. In fact, she's doubling down on her innovation convictions and has been buying up big time. Her trades and takes are commonly controversial, including her view that Tesla shares will be worth $1,500 by 2026. I asked Cathie how Tesla could fill a nearly 8 times value gap in such a short space of time.
There are many people who don't believe it or don't want to believe it. And so let's break this into two parts. So if we assume that electric vehicles are going to increase as a percent of total vehicle sales from roughly 10% in 2022 to 60 to 70% in 2027, which we believe they will, then you can get to $500 of that $1,500 just from that EV forecast, because Elon considers himself and Tesla a manufacturer of factories. That is the biggest gating factor here, scaling. The second part of it, that $1,000, is the autonomous assumption. The other thing we have to assume is that Tesla becomes the autonomous taxi platform, the primary one in the United States, if not elsewhere, but primarily in the United States. This is a winner-take-most race.
How concerned are you, if at all, about the so-called recessionary, high-interest rate environment that many economies are currently in, possibly delaying or even destructing the success of the companies that you invest in, and therefore their valuations too?
Innovation solves problems. Now, what's the big problem we're going to have in recession? Companies are going to have major margin problems. And one of the reasons they're going to have major margin problems is inventories piled up so dramatically around the world that companies are now having to clear the shelves with fire sale prices. And so their revenue growth rates and their margin structures are coming down. How do they defend against that? Well, they employ technology.
Looking at the return on your flagship fund, ARK Innovation, that return was negative 66% last year. That compares with a peak record 150% nearabouts return in the year 2020. I want to ask, do you view that drop of that scale as good or bad? And the reason I ask such a simple question is because I wonder how much the hype detracted from the underlying fundamentals of the companies that you invest in and why, and whether that was welcome or not.
As I'm looking at what happened, I remember toward the end of 2020 and early 21, I remember saying, keep some powder dry. This is not real. In fact, what had happened is there was a shift from growth to value in the fourth quarter of 2020, and it didn't affect us. And same through mid-February of 21. And then, of course, all hell broke loose when it came to our strategy. And so I think there was a lot of exuberance around our strategy and the technologies, because guess what? They did solve problems. And if you look at the performance, not of our stocks, but of the companies, our revenue growth rates are far superior to those in the broad market. And sure, some of our companies are not free cash flow positive yet. And that's because we want them to be investing aggressively now, because those investing aggressively now are going to get the lion's share of the spoils if we're right on how impactful artificial intelligence is going to be.
Now, I know that your ETF returns for this year are looking positive, but still certainly not enough to make up for the past 2 years. So what do you say, Cathie, to investors in ARK or just other investors who follow your own trades quite closely that are seeing significant losses that are yet to be made up?
Well, truth wins out. And if our research is right, then the returns that we expect, if our research is right and we're investing in exponential growth trends, then patience will be rewarded. I did not sell any of my ARK or crypto during this shellacking that we've seen, and thank God I could afford not to do that, because I do have significant exposure, disproportionate exposure. Advisors would say, what the heck are you doing? But thank God I can afford to do it. And I didn't sell anything and have been buying.
That's a perfect example of the level of high conviction that you have in your strategy. But ARK has faced a lot of criticism. There's been an anti-ARK ETF set up, and of all people, even Michael Burry says that he's shorting some of your bets. How does it feel, and how do you maintain such high conviction as you've just shown in the face of all of that?
Yeah, well, research is the source of our courage of conviction. I doubt the people who are negative on ARK are reading our research, and because it doesn't suit their purpose. And, in certain time frames, they're going to be right. If the market's time horizon shortens to 1 quarter, which it seemed to do last year, then our strategy is going to have a difficult time. As the market's time horizon extends, as the risk appetite picks up, say because inflation's coming down dramatically and interest rates will follow, then our strategy should do very well.
Cathie Wood, founder and chief investment officer of ARK Invest, thank you so much for your time. It's been wonderful to chat to you as always.
Oh, thank you, Madison. Always a delight, given the way that you've researched ARK, to have an interview with you. So thank you.
Okay, let's take a look at the numbers. These are all year-to-date figures, and it is comeback season for growth stocks. NASDAQ up almost 13% this year. The S&P up almost 7%. Aussie's All Ords up by 7.2%. And we're also getting a taste of the rally here in NZ. Our top 50 index is up almost 5% year-to-date. Now, we're all friends here, so I'd love your feedback. You can email any ideas or questions to marketswithmadison@nzherald.co.nz. I want to hear what you're buying and selling and who you want to hear from on this show next. And don't forget, tomorrow's Valentine's Day. Shears last longer than flowers. Now go put your money to work.